Let's talk about the ways that you can contribute extra money into your superannuation and you can get a tax deduction for it. So essentially there's two ways you can contribute money into your superannuation to get a tax outcome or tax advantage from doing so. So the main ways you can do this is by most commonly people will look at doing a salary sacrifice arrangement where your employer will essentially take a portion of your pay and put that into your super every pay cycle, and that money is then only taxed at 15% as opposed to your tax rate, which could be as high as 47%. So in that situation, when you're doing a salary sacrifice arrangement, let's just assume you get paid $1,000 a week. You want to salary sacrifice $100 a week, your employer will withhold that before it gets paid to you, and therefore you're getting a tax saving on every pay cycle. Whereas if you compare that to making a personal deductible contribution, that's where you actually make an after-tax contribution. Let's just say you get to near the end of the financial year and you want to put $5,000 into your superannuation fund. You can put that $5,000 in, and that's using after-tax money. And then you lodge a form called a notice of intent, and then you claim that back as a tax deduction. And ultimately what that's then going to do is lower your taxable income in that financial year, and you're going to get a bigger tax refund when you go to do your tax return. It is a little bit of a misconception that if you do a salary sacrifice or you do a personal deductible contribution that they might have different tax outcomes. That is not true whatsoever. The only difference there is when you're doing a salary sacrifice arrangement, you're actually getting a tax saving on every pay cycle, whereas when you do the personal deductible lump sum contribution strategy, you're only going to get that tax benefit when you lodge your tax return. There's also a spouse contribution that you can make. If you've got a low income earning spouse and you put $3,000 into their superannuation, you can get a $540 tax offset, which not a lot of people know about the spouse contribution tax offset. You need to be careful of just looking at what your spouse is earning to ensure you will fully qualify for that. And just lastly, when you're making a salary sacrifice or a personal deductible contribution, they will both count as part of your concessional contributions cap, which is currently $30,000 in this financial year. Or if you do have a super fund below $500,000, you might be able to utilize the catch-up contributions rule. Hope that makes sense, guys. And any questions, reach out.